Welcome back to English podcast session. I'm your host, John.
And I'm Amelia. Today, we're talking about something that's on everyone's mind as we move into 2025. What does it mean to invest smartly?
That's right. Whether you're investing in stocks, real estate, or even your personal growth, knowing how to do it wisely is more important than ever.
And don't worry if you're new to investing. We'll break it all down step by step. Plus, we've got a special vocabulary segment coming up later to help you with some key terms.
So, let's dive in. Amelia, what would you say is the first step to investing smartly in 2025?
I'd say it's understanding your financial goals. Are you saving for retirement? A house? Or maybe just looking to grow your wealth?
That's a great point. Goals help you determine the kind of investments that suit you best. For example, if you're saving for something long-term, you might consider stocks or mutual funds.
Exactly. But if you need your money in the short term, something like a high-yield savings account or bonds might be better. Risk tolerance is another thing to think about.
Risk tolerance basically means how much risk you're comfortable taking with your money. Amelia, would you say your risk tolerance is high or low?
I'd say medium. I'm okay with some risk as long as the potential rewards are worth it. What about you?
I think I'm more on the cautious side. I prefer safer investments, even if the returns are smaller. Speaking of returns, let's talk about the importance of doing research.
Absolutely. Smart investing in 2025 is all about staying informed. Before you put your money into anything, you need to understand what you're investing in. That means reading up on market trends, company performance, and even global events.
Right. For example, if you're investing in tech stocks, you'll want to know which companies are leading in AI or renewable energy. These sectors are expected to grow significantly.
And don't forget about diversification. This means spreading your money across different types of investments so you're not putting all your eggs in one basket.
Great metaphor, Amelia. Diversification helps reduce risk because if one investment performs poorly, others might do well and balance it out.
That's so true. Now, John, what about budgeting for investments? How much should people set aside?
Good question. A common rule of thumb is to invest 15-20% of your income. But this can vary depending on your financial situation.
And always make sure you've got an emergency fund first. You don't want to risk money you might need for unexpected expenses.
Speaking of risk, let's touch on one of the biggest mistakes people make: emotional investing.
Oh, yes. That's when you let your emotions dictate your decisions. For example, selling stocks just because the market is down.
Right. Instead, stick to your plan and think long-term. Remember, markets go up and down, but smart investments grow over time.
That's a great segue to our vocabulary break. Let's take a short pause to introduce some key investing terms.
Welcome to our vocabulary segment. We're going to explain a few important terms that will help you understand today's topic better.
First up, portfolio. A portfolio is the collection of all your investments. For example, your portfolio might include stocks, bonds, and real estate.
Next, compound interest. This is the interest you earn not only on your initial investment, but also on the interest it accumulates over time. For example, if you invest $1,000 at 5% interest, you'll earn $50 in the first year. In the second year, you'll earn interest on $1,050.
Great example, John. Now, let's talk about asset allocation. This means dividing your investments among different asset classes like stocks, bonds, and cash. For instance, a young investor might put 70% in stocks, 20% in bonds, and 10% in cash.
Another key term is liquidity. This refers to how easily you can convert an investment into cash without losing value. For example, a savings account is very liquid, but selling a house takes time.
And finally, bear market and bull market. A bear market is when prices are falling, and a bull market is when prices are rising. For example, in a bull market, investors feel confident and buy more.
That wraps up our vocabulary segment. let's get back to the discussion.
Thanks for sticking with us. Now, John, let's talk about the role of technology in smart investing.
Great topic. In 2025, technology is a game changer. You can use apps to track your spending, research investments, and even automate your portfolio.
Exactly. And AI tools can analyze market trends and make personalized recommendations. But remember, technology is a tool, not a replacement for critical thinking.
Very true. Amelia, any tips for beginners who might feel overwhelmed?
Start small. You don't need a lot of money to begin investing. Platforms like micro-investing apps allow you to invest with as little as $5.
That's such good advice. And don't forget to keep learning. Read books, follow financial news, and listen to podcasts like this one.
Couldn't agree more. All right, before we wrap up, let's end with a short story that ties everything together.
Imagine this, it's 2025, and Sarah, a young professional, decides to start investing. She's nervous but determined. First, she sets a goal saving for a down payment on a house in 5 years.
Sarah researches and creates a diversified portfolio with 60% in stocks, 30% in bonds, and 10% in a high-yield savings account. She also uses a budgeting app to track her spending and save consistently.
Over time, Sarah learns to ignore short-term market fluctuations and focuses on her long-term plan. By the end of 5 years, she not only reaches her goal but also gains the confidence to keep investing.
The moral of the story? Smart investing is about setting goals, staying informed, and being patient.
Well said, Amelia. That's all for today's episode of English Podcast Session.
Thanks for listening. Don't forget to subscribe and share this episode with your friends.
See you next time. And remember, invest smartly and watch your future grow.